Imagine this. You wake up tomorrow morning, grab your phone, open your banking app, and right there on the same screen where you see your savings account, your checking account, your stock portfolio, and your retirement balance, you see Bitcoin. Not in a separate crypto app, not on an exchange you barely trust, not stored behind a 24-word seed phrase you're terrified of losing, just sitting there, inside your bank, fully integrated, reported on your monthly statement, managed like any other asset. For years, that idea sounded like science fiction. Crypto was supposed to be outside the system. Banks were supposed to fight it. Regulators were supposed to crush it. And yet, here we are. In 2026, some of the most powerful financial institutions in the world are not just tolerating Bitcoin. They're building around it. They're integrating it. They're institutionalizing it. And if you think this is just another headline, just another hype cycle, you are missing the magnitude of what's happening. Welcome to US Money Explained. On this channel, we break down the biggest shifts in finance, macroeconomics, and digital assets so you can actually understand what's happening beneath the surface. Not the hype, not the fear, the structure. And today, we're talking about a structural shift that could define the next decade of global finance. Because when giants like Citigroup and Morgan Stanley make coordinated moves into Bitcoin custody, spot trading, lending, and integrated wealth management, that is not a marketing experiment. That is the traditional financial system extending its architecture to absorb crypto. Let's slow this down and really understand what's happening. For most of Bitcoin's life, it lived in a parallel universe. You had exchanges like Coinbase or Binance, you had hardware wallets, you had cold storage, you had seed phrases, you had an entire ecosystem that was separate from traditional finance. If you were a hedge fund or pension fund and wanted Bitcoin exposure, you had to jump through operational hoops. Custody was complicated, reporting was messy, compliance teams were nervous, risk officers were skeptical. Now picture an institution like Citigroup. This is not a startup experimenting with new technology. This is a banking giant that connects to over 200 payment and settlement networks globally. It moves money for governments, multinational corporations, and some of the largest institutional investors on the planet. When an institution like that decides to build institutional Bitcoin custody, it is not doing it casually. Custody in finance is not just about holding an asset. It is about safekeeping, reporting, compliance, settlement, collateral management, and integration with the rest of the financial system. And when you own stocks through a brokerage account, you do not physically hold those shares. A custodian holds them on your behalf. That custodian ensures regulatory compliance, handles corporate actions, manages settlement cycles, and produces tax documentation. It is the plumbing behind the scenes. Bitcoin historically did not fit into that plumbing. It was bearer property controlled by private keys. That was part of its revolutionary appeal. You did not need an intermediary. You did not need permission. You could hold your own wealth directly. But here is the reality. Most large institutions do not want to manage private keys. They do not want to build in-house cryptographic security teams. They do not want operational risk tied to misplaced hardware wallets. They want institutional-grade custody that integrates with their existing risk frameworks. Citigroup's announcement that it will offer institutional Bitcoin custody later this year signals something profound. It means that within their infrastructure, crypto, securities, and cash will exist inside a unified system. That matters because financial institutions operate on consolidated balance sheets. They need visibility. They need unified reporting. They need cross-asset collateral management. Now think about what that implies. If Bitcoin sits inside the same master account as US Treasuries and other securities, it becomes eligible for cross-margining. Cross-margining is a concept many retail investors do not fully appreciate, but institutions live and breathe it. It allows them to use one asset as collateral for another position. A hedge fund might use treasury bonds as collateral to take leveraged positions in equities or derivatives. It increases capital efficiency. If Bitcoin becomes eligible collateral inside traditional financial infrastructure, it changes its institutional utility. It is no longer just a speculative asset. It becomes balance sheet collateral. That is a different level of integration, and here is where the operational challenge becomes fascinating. Traditional markets operate on schedules. The New York Stock Exchange opens and closes at specific times. Settlement occurs in defined cycles. Back-office systems are built around those rhythms. Bitcoin does not care about business hours. It trades 24 hours a day, 7 days a week. There's no closing bell. There's no weekend shutdown. When a global bank integrates Bitcoin custody, it must adapt its systems to a 24/7 asset. That means real-time risk monitoring. It means round-the-clock settlement capability. It means liquidity management that does not pause on Saturday. That is not a trivial upgrade. It requires infrastructure transformation. At the same time, consider what Morgan Stanley is doing. This is a firm that oversees roughly $8 trillion in assets. That scale is almost hard to comprehend. It services high net worth individuals, family offices, institutions, and mainstream wealth clients. Morgan Stanley is not just dabbling in a Bitcoin ETF. It is moving on multiple fronts. It has filed for exchange-traded products tied to Bitcoin and Ethereum. It is rolling out spot crypto trading on E*TRADE. It is exploring wallet technology integration across its wealth management platform. It is evaluating lending and yield strategies tied to digital assets. Let's unpack the significance of that. An ETF is familiar. It is comfortable. It fits neatly into brokerage accounts and retirement portfolios. For many investors, buying a Bitcoin ETF feels no different than buying an S&P 500 ETF. That familiarity lowers psychological barriers. But spot trading is different. Spot trading means direct exposure to the underlying asset. When spot crypto trading becomes available on E*TRADE, millions of users who already trade stocks and options suddenly have seamless access to crypto within their existing interface. No new account, no new learning curve, no separate exchange. Distribution is everything in finance. Morgan Stanley is not just building a product. It is leveraging an existing distribution network of wealth clients and retail investors. And then there is the wallet integration piece. For high net worth individuals, wealth management is about holistic oversight. Advisors review asset allocation across equities, bonds, alternatives, and real estate. If crypto holdings sit outside that ecosystem, they remain peripheral. Once integrated, they become part of formal portfolio strategy. The exploration of digital asset lending and yield products is equally significant. Crypto-native platforms have offered yield opportunities for years, often with high risk and minimal transparency. When a traditional wealth manager evaluates similar products within regulated frameworks, it signals a maturation process. It suggests that digital assets are being evaluated through the same risk and compliance lens as traditional instruments. Now zoom out even further. This is not happening in isolation. The New York Stock Exchange has discussed blockchain-based trading venues and expanded trading windows. NASDAQ has explored nearly round-the-clock trading for certain products. These developments point toward a convergence. Traditional markets are adapting to the 24/7 paradigm pioneered by crypto. For decades, financial markets were bounded by geography and time zones. Now, technology erodes those boundaries. If digital assets trade continuously, and if tokenized securities can settle on blockchain rails, the logic of fixed trading hours weakens. We are watching the architecture of global finance evolve in real time. But here is the deeper question. What does this mean for Bitcoin's identity? Bitcoin was born in opposition to the traditional system. It emerged after the 2008 financial crisis as an alternative to centralized banking. Its design emphasized self-custody, censorship resistance, and independence from intermediaries. When large banks custody Bitcoin, critics argue that it compromises that ethos. If your Bitcoin is held by a bank, it can be frozen. It can be subject to compliance rules. It re-enters the domain of institutional control. That critique is not trivial. It highlights a philosophical divide within the crypto community. Some view institutional adoption as co-option. Others see it as validation. But consider this carefully. The existence of institutional custody does not eliminate self-custody. Individuals who value direct control can still hold their own keys. What changes is optionality. The market expands. Pension funds, sovereign wealth funds, and conservative investors who would never self-custody now have a pathway to participate. Liquidity increases. Market depth increases. Integration with capital markets deepens. And from a macro perspective, that integration matters. Institutional capital is vast. Even small allocation shifts from traditional portfolios into digital assets can have meaningful impact. When wealth managers begin including crypto in strategic asset allocation models, the asset class transitions from fringe speculation to recognized portfolio component. There's also a competitive dynamic unfolding. When one major bank builds custody infrastructure, competitors cannot ignore it. If clients demand exposure and operational simplicity, institutions must respond or risk losing assets under management. Competition accelerates integration. Now let's address regulation, because no discussion of institutional crypto adoption is complete without it. For years, regulatory ambiguity slowed bank participation. Institutions feared enforcement actions. They worried about unclear custody rules. They hesitated due to compliance uncertainty. The fact that trillion-dollar institutions are now publicly building and launching digital asset products indicates that regulatory frameworks have reached sufficient clarity for risk committees to approve capital allocation and infrastructure investment. That does not mean risk disappears. Regulation evolves. Policy shifts. Political winds change. But institutions of this scale do not commit resources lightly. They assess regulatory risk meticulously. So what does all this mean for you as an investor or observer? First, infrastructure drives adoption. When operational barriers fall, participation broadens. Friction is often a bigger deterrent than ideology. If buying Bitcoin becomes as simple as buying a stock, more people will consider it. Second, 24/7 markets reshape behavior. Continuous trading introduces new risk management challenges. Volatility can occur outside traditional business hours. Portfolio oversight may need to adapt. Third, integration increases correlation potential. As Bitcoin becomes embedded in traditional portfolios, its behavior may increasingly reflect macro liquidity conditions, interest rate cycles, and institutional flows. Fourth, competition among banks may lead to product innovation. Yield strategies, lending mechanisms, tokenized securities, and cross-collateralized portfolios could redefine how assets interact. And finally, this moment represents a structural inflection point. Not because Bitcoin's price will instantly skyrocket, not because banks have suddenly become crypto evangelists, but because the boundary between traditional finance and digital assets is dissolving. The handshake between Wall Street and crypto is not symbolic, it is architectural. Imagine a world 5 years from now. A young professional opens a wealth account. They allocate to index funds, bonds, tokenized real estate, and Bitcoin within one unified dashboard. Their advisor discusses digital asset exposure alongside dividend yield and duration risk. Their bank processes transactions 24 hours a day across asset classes. That world is no longer hypothetical. The infrastructure is being built right now, and when infrastructure changes, behavior follows. On US Money Explained, we do not chase hype, we analyze structure. What we are witnessing is not the end of decentralization, it is the expansion of access. Bitcoin can remain self-custodied for those who choose it. At the same time, it can become embedded in institutional balance sheets. Two realities can coexist. The real story is not whether banks like Bitcoin. It is that they can no longer ignore it. Client demand, competitive pressure, and technological evolution have converged. So the next time you open your banking app and imagine seeing Bitcoin sitting there next to your savings account, understand that this is not a fantasy scenario. It is the logical outcome of institutional integration already underway. And whether you are bullish, skeptical, or undecided, one thing is clear. The financial system of 2030 will not look like the financial system of 2010. If you found this breakdown valuable, if it helped you see beyond the headlines and understand the structural shift beneath the surface, make sure you like this video. Subscribe to US Money Explained so you never miss an in-depth analysis of the forces reshaping money, markets, and power. And turn on notifications, because the pace of change is accelerating. The handshake has happened. The infrastructure is being built. The question is not whether the system is changing. The question is whether you are paying attention. This is US Money Explained, and we will see you in the next one.